Good morning, everyone. Thank you for joining us. I am delighted to be joined today by Andrew and Esperanza. Natasha does give her apologies. She fell ill this morning and was unable to join us. And so I guess what we thought we'd do is start off the day, following Sir Ken's "We're All Doomed" speech, which I thought was a little bit more, highlighting the opportunities than he initially set out, with a panel that's very simple, very straightforward, very right down the fairway, and talk about geopolitics, because nothing ever changes there that gives us risks. Andrew, I'm going to jump in right with you, and I want you to start by laying out, from your perspective, some of the impacts and implications of the geopolitical situations across regions and how you're thinking about that across both the short and the long term.
Yeah, a really easy question. We might be here till the evening. I'm really glad, firstly, just that Sir Ken talked about opportunities, because some of you know I dislike my title, Geopolitical Risk, because I would like to add the word opportunity to the end of that. It's not all bad, despite some of these issues. But what are we concerned about? Number one is, despite what's going on in Westminster, it is not the biggest issue for us. It would probably be Washington and what happens in the US. Now, what do I mean by that? We've got the year of the midterms, we've got a year of affordability, you've got gasoline prices now heading towards $5 average per gallon in June. That is political kryptonite. Diesel's above $6. Real issues. And you've got the worst consumer confidence in the US for a decade. That's despite the S&P being at record highs, with real concentration of capex in the Magnificent Seven and AI. So, we're concerned about that and potential impacts, AI on private credit, software and other issues, the lack of energy in the US for their data centers. So a lot actually revolves around what comes out of the US, and we've got tariffs and trade and foreign policy. Section 301 tariffs, there's 6 investigations against China at the moment. Where do they go? You've got threats against the EU, 25% on autos if the EU doesn't ratify the Turnberry Agreement by the 4th of July. It's just that trade and foreign policy out of Washington is really, really important. So that's the number one issue. You could talk Cuba, not really market impactful necessarily. Panama, a lot of people forget. C.K. Hutchison has just been, or their ownership of the 2 key port facilities in the canal have been declared null and void by the Panamanian court. That allows the US to control 40% of their container traffic through the canal. Then you've got the Arctic. So just those America first, trade routes, control of oil, etc. US-China, the biggest issue we face in a generation. This week, great to plan this event around the Xi Jinping-Trump summit. Really important. We're certainly constructive, positive for at least 18 months. You've got a big event coming, the October 2027 Party Congress in Beijing, then the March 2028 beginning of that 5-year term. There's a particularly important event smack in the middle of that. That is the January 2028 Taiwanese election. It is really important. Both sides between now and then want stability, a little bit of just calm or a phony peace in a way.
Phony peace. And you've given a lot of specific country implications there, but you probably see better than most the impact on the entire supply chain. Do you want to just double click on that for a minute?
Yeah, and this comes out of not just the Middle East. You've got 600, 1,000 ships potentially west of the Strait. Yeah. Even if there was a deal tomorrow between Iran and the US, where there certainly won't be, but it will take 2 to 3 months to get back to some sort of normality. You've got all those ships need to be prioritized. Which commodities get prioritized? Is it helium? Is it oil? Is it gas? Is it fertilizer? Is it aluminium? All these other petrochemicals, all these other issues. So the supply chain certainly has been impacted. Maybe 10 to 15% of the global container fleet is off market or dislocated. But the biggest issue is not necessarily the short to medium term impacts of that supply chain disruption in the Persian Gulf. It is actually the advanced tech supply chain going forward. China is maybe ahead in 70% of all tech, maybe, not advanced tech. Now, what are the Chinese missing? They're missing the key lithography technology, ASML's technology for the advanced chips. So they need time to build their own. They're still reliant on Taiwan. And the US as well. What are they missing? They are exceptionally vulnerable to Chinese rare earth, refined rare earths, I should say. When can they break that dependency? President Trump is doing as much as he can, to be fair, but it's still probably 3-5 years, if not longer, before they break that dependency. So that advanced tech supply chain is breaking. I don't want to say snapping, but it's certainly weakening. And that's a big issue because you can't have AI without mines in Africa. You can't have AI without ASML. So all this concentration of capex, what happens when that supply chain breaks? When China gets their 2, 3, 4 nanometer chip, then potentially NVIDIA doesn't have 20% of their market in China. That does impact potential valuations, et cetera. So, I don't know that, but there are certainly repercussions.
Yeah, absolutely, and the interconnected nature.
Absolutely.
And Esperanza, as an Australian headquartered firm with offices in Europe, US, Asia, how are you thinking holistically about the risk profile that you're facing, and how are you kind of having those discussions internally?
That's a very good question. But before I got into the question, we will have a conversation later about risk and opportunities. I'm still on a mission that risk is not only downside, but also upside. So I'm not. So I think we are an infrastructure investor. We are a long-term infrastructure investor, and we have a long-term, a very well-diversified portfolio geographically. So I think we mainly invest in developed markets. That I think is something to take into consideration: Australia, North America, the UK, and Europe. And the way I see this well-diversified portfolio is that it provides some certain protection. But obviously, as Andrew has been telling us, geopolitical risk manifests very differently by region, but it's extremely interconnected, and those interconnections matter more than ever. So I think the global footprint that we have introduces as well complexity. So that complexity must be actively managed, because the way I see it is that diversification doesn't remove risk. It definitely, what it does, it changes its form. So we look at cross-border regulatory complexity. We look as well as sanctions and trade policy spillovers, currency, funding, and insurance also consideration. So I think obviously one policy swing in one jurisdiction rapidly affect other jurisdictions through capital markets, trade flows, regulation, and energy systems. So from a risk perspective, the way we look at it is that no single geopolitical shock exists in isolation. We focus heavily in interdependencies and second and third order effects, and not just in the headline risk.
Yeah, absolutely. Andrew, any thoughts on kind of the interconnected nature Esperanza's laid out?
I couldn't agree more. Everything's interconnected. One thing happens in China and it will impact all of us. And maybe just to clarify that, the Persian Gulf, the Chinese get 40% of their energy imports from the Gulf. What are they doing about it? Well, actually, the constraint of the Strait of Hormuz is actually validating their strategy, because they're doubling down on renewable energy. They produce more renewable energy than the rest of the world combined. They also produce coal-fired power stations at a rapid rate, so it's not necessarily an environmental issue, it's just a strategigic issue, and they're trying to reduce their reliance on that Persian Gulf oil and gas supply. So yeah, absolutely, that's just one example. There are tons.
And I think you've done a very good job articulating the kind of current landscape across geographies, and appreciating that nobody in the room has a crystal ball, otherwise we would all be in a different profession. If you were to pull this forward 5 years and think about how are some of these risks evolving with the velocity of change that we are seeing, what does it look like? If we're sitting in this room in 5 years' time, what are the risks that we're talking about? And if you want to, I like the scenarios that you've given, Andrew and Esperanza. If you want to pull some of those scenarios forward, how do you see that playing out?
For me, actually, we'll be talking about a lot of the same stuff. I think Ken talked about mythos and Anthropic, and I don't know if you mentioned quantum. Where are we in the quantum computing race? Who's ahead? That's a major, major issue for cyber. But actually, it's a major issue for that advanced tech supply chain, as I mentioned in the beginning. So, definitely quantum will become much more central. We haven't mentioned Taiwan at all. Where are we in 5 years? I mentioned the January 2028 election. Xi Jinping has a very clear plan. Greater China by 2049. What does that really mean? Probably in the next 5-year Party Congress. An invasion is such low probability, and in 5 years, we might be in a position where the Kuomintang haven't won that election. The current government is still there. Beijing doesn't like it. So maybe we're seeing more quarantines, more blockades, just becoming the new normal. That's much more likely. So in 5 years, I think that will be front and center. So cyber, Taiwan, Where is the US-European relationship, I should say European Union relationship by then? Where is NATO, Article 5? Where is the Russia-Ukraine? I think a lot of these issues we'll be talking about, and the Middle East, we'll be talking about diversity of supply chains, where if you don't put or send your oil and gas through the Strait, where do you send it? So opportunities, we're certainly looking at the Middle East as a potential opportunity longer term because of that reconstruction, diversification, pipelines, etc. So look, that's simple. There's a lot of issues. And then where is the US? Where is America first? No US president will say no to tariff revenue, whether it's a Democrat or Republican. So 5 years, yeah, I mean, that will come around very quickly. We'll be talking about some of these same issues.
And I think it's interesting bringing in the geostrategic and also the geoeconomic elements of that, from the physical components to the software. Esperanza, 5 years?
Yeah, I'm going to give a slightly different perspective. More than how the geopolitical scenario would look like is what would be the type of discussions that we will be having here. And I think, I hope that rather than trying to figure what a scenario will be coming, is more on how organizations have actually embedded those geopolitical risks into decision making. I hope that there will be more conversations about resilience trade-offs, and cost versus redundancy, efficiency versus sovereignty, short-term returns versus long-term returns, and maybe some discussion about who is paying for that resilience, governments, investors, consumers, insurance, all of the above. I think from infrastructure lens and a pension capital lens, I think what I'm seeing is that infrastructure is treated more as a national capability, as the security or resilience. I'm hoping to have a different conversation about climate as well, and energy transition, and what will be the digital backbones. But it will be more about embedding risk and, as you point out, seeing the opportunities.
Could I add
Absolutely,
that's a really good point, the risk management. Where are we in 5 years in a way?
Chief Risk Officer.
I mean, but in a way, my job is to make sure the leadership of our bank has, and all constituent parts of the bank have a consistent and better understanding about how these global issues impact markets, both positively and negatively, our strategy, our risk, limits, exposures, and our clients. So in a way, in 5 years' time, we would hope that would be much more mature. At the moment, I have a team of me, but that's okay because in a way I have flexibility to at least influence our board and ExCo. But that in 5 years' time, we should have a better understanding that it's not geopolitics, is not a separate issue because it's bad. It's actually the good times, and it's maybe more risk and opportunity, but actually global affairs. What's that strategic view? And
team of you is still formidable, Andrew. Esperanza.
But I mean, the way we are thinking about politics and the way I think about mitigating the risk and leveraging the opportunities is actually, in our jargon as Chief Risk Officer, is more an enterprise-wide approach. And I think it's bringing together you and your whole team of one with other participants in the organization, the investment teams, the risk, the legal, the procurement, and having that conversation, because ultimately it's not about, I would say, the way I see it, is not about forecasting the future, it's how we incorporate resilience by design, and that kind of collaboration, partnership, and the conversation is, I think, in my view, what is making organizations to be more resilient, and it's all about preparedness. So it's not about big teams in silos. I think it's the conversations between the different participants of the ecosystem.
I think that's absolutely right. And we're starting to rise to Sir Ken's challenge on opportunities as well as the risks. I think innovation obviously poses a number of risks in terms of the uncertainty and where that is going. But I think there's a lot of opportunities that can arise from the innovation and what we're seeing happening in terms of mitigating some of these risks. Esperanza, do you want to start us off on how innovation is really mitigating some of these geopolitical risks?
So I was yesterday in the Investment Association Private Markets Summit, and I'm going to take one sentence that I heard from one of the panelists, that I think at the heart of innovation is people working together. And I think that was because when we think about innovation, we kind of think of a technology, but it's also about people. Another observation that I have is that innovation is not optional, it's now incorporated in how risks are mitigated. So, you know, to the comment that I made earlier on, I see, and particularly in asset management, risk creates optionality, and that optionality helps to allocate capital where returns properly compensate for that uncertainty. So when we look at innovation, we look at operational innovation on one hand, so digital, particularly in our assets, all about digital monitoring, predictive maintenance, cyber resilience. That was mentioned as well by Cerdan before, smarter energy systems. From the CRO perspective, the innovation that we are incorporating is moving from linear scenarios to network scenarios, mindful of the complexity that it could bring. So we look also at second and third order effects, as I said earlier on, and these trade-offs that exist, and explaining them and framing them clearly so it facilitates decision making.
Andrew, any thoughts?
Yeah, maybe I'll look at it from a different lens. I mean, the New World Order, protectionism, isolationism, it is actually driving some of this innovation. Certainly in Europe, energy independence, where the Europeans go to get their energy from. You know, that does sometimes drive innovation around. Well, we need renewables. We can't rely on US LNG. We can't rely on Russian pipe gas or LNG. Maybe we get pipelines from Qatar through Syria, link up with Turk Stream. You know, there are other ways. I know everyone would expect, you know, let's talk about AI and innovation, but maybe put that to one side. It's just political decision making, and maybe the private sector saying, where are these investments? And the big one for me is not necessarily energy or defense independence in Europe, it is de-dollarization.
Yeah.
Big issue, and maybe I don't mean de-dollarization, it's just the Chinese have a very clear plan, break or at least reduce US dominance of the financial system. How are they doing that? Central bank digital currencies, they are a few years ahead of the UK, Europe, the US. They've got their central bank digital currency, their ECNY. It's gaining more and more momentum domestically. Obviously, they're selling US treasuries. I should say their holdings of US treasuries are being reduced every maybe 2% a month. They're down to 640 billion in March from a high of 1.3 trillion. Why is gold so high? Well, a lot of central banks are buying gold, but Chinese central bank, PBOC, is buying gold. They buy maybe 30,000 ounces a month, 18 straight months of purchases. So why are they doing that? They're just innovating because they're trying to get in a position to at least get the Shanghai Cooperation Organization or the BRICS to price more in maybe an eventual internationalization of the CNY. Maybe they're on the DLT. What does that look like in 5 years' time? You know, that is coming thick and fast, and I think if we ignore it, it will be at our peril.
And I think particularly relevant for this audience is whether or not you see that as an evolution, or if you see tipping points baked into that, and probably an unfair question to ask live in front of everyone, but I think it's helpful to understand where you might see those inflection points.
That's what I mean, not de-dollarization is not a real thing. You know, we're not going to take RMB as collateral yet. I mean, it's just not the dominant currency, but that would be a tipping point if global banks started to look at China in a different way. And, you know, some tipping points, they are starting. You've just had a really big event in the last 10 days that probably hasn't got the coverage it should, and that's the conflict of laws between China and the US. So you've got these regulations coming out of Beijing, one, extraterritoriality of their laws to combat US sanctions in effect, and then their orders to US and to Chinese domestic and multilaterals in China not to abide by US sanctions. That is a big, big issue. We've never seen it before. That is just one element of this wider, I suppose, the wider relationship and their plans to at least break these supply chains.
Yeah, that's interesting. Having covered all of financial architecture, all of supply chains, all of AI and quantum, I don't think there's many things that we've overlooked. But Esperanza, what is your view on the global narrative? Where do you think collectively we are potentially overlooking some of these shifts and their implications?
Well, some of the work that we are currently doing in IFM, and I think it's particularly pertinent for infrastructure, is reviewing or revisiting partnerships with governments and relationship with private capital. So one shift that we are seeing there is that geopolitics have pushed infrastructure from being purely an economic discussion to being a strategic. And governments are increasingly seeing infrastructure, to your point on the tipping point, critical to national resilience, security, and competitiveness. So we are seeing I would say, three key trends in those partnerships with governments and private capital and pension capital. I think one on the shift from the cost of capital to the strategic resilience, and those partnerships have been driven by energy security, supply chain resilience, digital sovereignty, and climate transition. And that is raising the expectations on redundancy, continuity, and security by design. And that translates into more scrutiny, more tests on national interest, and also higher sensitivity to foreign ownership for us being an Australian asset manager. Another trend that we are seeing is unlocking pension capital. I think in the current times when there are fiscal constraints, governments are having thinner balance sheets. There is an appetite for private capital, and pension capital is recognized by some governments as long-term patient capital and is aligned with public outcomes. So we have been doing some work with governments on policy blueprints to enlarge the pipeline of investable opportunities. And you probably, some of you may have seen yesterday, there was an announcement from the Office for Investment of the creation of the Supers units, that is the Australian Pension Fund commitment to invest 90 billion in the UK. And the third trend that I'm seeing is that risk allocation is getting tougher. The partnerships must address risks that in the past probably wasn't at the front line, like sanctions or cyber risk or supply chain disruption, regulatory volatility, and also regulatory fragmentation. And if it's not designed properly, the projects can be kind of stalled, or they can also be uninsurable. That is a big concern. I think we are also taking into consideration technical gaps, capability gaps, and very importantly, that is also coming to the front line is community trust and public scrutiny, I would say. So I think it's extremely important that all the participants in the ecosystem have that partnership, that collaboration, and that transparency across all of them: regulators, governments, investors, insurers, and the community.
Really good deep dive there into public-private partnerships, definitely, and I know that's an issue very near and dear to many in the UK markets in particular. Andrew, I'd love to get your thoughts on that from a Barclays perspective, but before we go deep onto that, any global impacts that you think that we're overlooking from your perspective in your seat?
A lot is the answer, but I think we should look closer to home as well. The UK, where is the UK? I know it's unfair to talk about it this morning, but where is the UK-EU relationship? Where do we go? Whoever the Prime Minister might be, what is that relationship going to look like? I mean, June is only next month, and that's when the 5-year Brexit deal has to be at least renewed or at least agreed to continue the negotiations. That's coming very, very quickly, but that is overlooked because there are a lot of opportunities potentially in that for businesses. And I don't just mean trade, it could be financial services, could be youth mobility, whatever it might be, but the critical one is defence. Yeah. Now, obviously, the UK does not yet have access to the 150 billion joint borrowing under SAFE from Brussels. We will have to pay to be a part of that, but defence procurement is critical in the future. So everyone's looking at the share price of primes, European defence primes, but actually it's longer term. Where is that joint borrowing? When the fiscal headroom is constrained by potential inflationary impacts of the Middle East, that will have an impact, definitely. and certainly if there's not enough growth. So yeah, I just think UK-EU relationship is underlooked, I think, and maybe the Middle East, India, that nexus for us from a UK point of view is really critical. We have advantages in those regions.
That's great, and I think as you talked about earlier also on the supply chain and the interconnectivity of that, as we ramp up defense spending in particular through the supply chains, we need to increase capacity there, linking back to defense procurement. I mean, it all...
Can I add one other thing that's probably, it's very rare now you hear, I think you mentioned ESG, that's the first time I've heard of that for a while. Certainly when I travel to the US, it's not front and center anymore, but physical climate risk is really important. Last year, the monsoon in India was erratic. What happened? New Delhi put in export controls on rice. That caused inflation in the Philippines and Southeast Asia immediately. So when you have all these other pressures from supply chain constraints, aluminium, gas, production of urea and sulfur and petrochemicals, etc. If that happens again, we have bigger issues on food security, food production, and I don't mean necessarily from an ESG. I just mean from a confidence point of view, markets, etc. It will have an impact.
Absolutely, from a risk perspective, and also have potential impacts on the infrastructure and shipping and absolutely everything we've talked about. I have heard ESG more shoehorned into ESSG occasionally as well, to put a security lens on that.
I thought you were going to say semiconductors. But
oh no,
yeah.
Semiconductors.
And I think it's important. I think the way we look at sustainability or climate sustainability risks is about a risk management tool more than an investment tool, I would say. I think ESG has been aligned to a way of investing. For us, particularly as a long-term investor, physical risk and transition risk has significant implications in how do you operate the asset, particularly in the long term. The last thing that you want to have is an stranded asset because it hasn't been able to transition the risks. So I think more than an investment theme that it could be, I think it should be a risk management tool. And I'm conscious that I really didn't ask your question, Lisa. I think another thing that I would add that we need to take into consideration today is contractual resilience. I think currently, particularly in a long-term investment, with the amount of uncertainty that we have, the contractual agreements and designs need to take into consideration that long-term uncertainty. Similarly, particularly when you have a global investor in different jurisdictions, is the evolution of tax regimes.
No, definitely.
This is something that another thing that we shouldn't overlook is public scrutiny and community trust as well. That it, particularly in infrastructure, plays a significant role, particularly with foreign investments as well.
Well, especially with the IFM as such a long-term investor from a pensions perspective, I mean, that trust is incredibly important as you think about both the political architecture, but the financial architecture. Where will you be over a 30-year horizon?
Exactly.
Is often where you're thinking.
Yeah.
As a CRO, how are you seeing your role evolve? What do you think about the changing role of the CRO in this more dynamic landscape as you have to think through these second and third order implications in real time?
I think the role has changed significantly, and I think it's still changing. And also there are different archetypes of CRO depending on what is your risk appetite and risk profile. But what I would say, I think we are becoming more and more a combination of a translator and a conductor. Because I think it's important to have, if we talk about the interconnectivity, I don't think my role is to forecast the future. It's about to make the organization resilient and to provide the organization with the right tools to incorporate risk and opportunities in decision making. So I see ourselves a little bit like a conductor that brings everyone together in the room, not to predict the future, but to challenge assumptions in terms of the scenario generation. I think I see ourselves as well in identifying what are the vulnerabilities of the firm and seeing the opportunities to either create that resilience and preparedness within the firm, but also to give the organization what are the trade-offs in order to make decisions to deliver on that strategy. So I think it's a more forward-looking approach, it's an enterprise approach, and it's about providing the tools rather than trying to forecast the risk. I see we are transitioning from a data-driven function that tries to predict the future to one that is a more forward-looking, that provides the tools to facilitate that decision-making. It's more strategic, I would say.
And I think that strategic and enterprise-wide approach is really well made. I think especially as everybody in the room is considering that for their own organizations, their own investors, and their own stakeholders. Andrew, as you think about it from a Barclays perspective, but for the broader organization, you talked a lot about the supply chain changes. We've talked a lot about the changing kind of geostrategic landscape. How are you seeing that change the day-to-day business operations, both in terms of how you're executing on particular mandates, but also how you're thinking about operational resilience, stakeholder engagement, political engagement, regulatory engagement?
Yeah, it's really interesting. In a way, I see myself as a bit of the glue to all other parts of the bank, whether it's government relations to markets or, every day I will be on global markets calls or banking calls, and then I'll speak to government relations or legal or compliance. So actually that has been great, just to make sure we're all on the same page, what's coming. But actually it's the risk management. I don't have a crystal ball. I don't really know what's coming, obviously. None of us do, but we can then put in place more professional risk management forums. So whether it's Greater China, whether it's Middle East or the US or Europe or Russia, Ukraine, at least every week or every month we will get the business or the decision makers in the bank, not just the business, to say this is what's happening, this is what's happened this month, this is where we are, this is how many treasuries they've sold, or in the relation to China, or gold purchases, or this is the latest US export controls or something. So actually that gives us a really good view to then, for risk and compliance and others, to then say, okay, what does this mean for our function and our business? And it could be the FX teams tomorrow, what happens to FX rates in Turkey, whatever it might be, and that's the opportunity bit as well.
And I think the opportunity and the risk bit is well articulated there. I guess just pushing on that a little bit more, when you have a situation where we have an increasingly diverse inherent risk landscape, right? We have different risks, we have different models to understand what is happening against a backdrop of quite a strong deregulatory agenda in many parts of the world. We're seeing a tension in many organizations where on the one hand, we're kind of seeing a weakening of that risk function or a desire to lighten the risk function. On the other hand, we're seeing a very different inherent risk landscape. And how are you thinking about solving that tension?
It's not really so. We just have to know what's coming, right? That's building good instrumental relationships, whether it's US regulators or with Capitol Hill or Westminster, or wherever it might be. Just what's coming, what's on their mind, and just preparing better. And maybe with those relationships, briefing them on what this may mean to a foreign business, whether it's taxing the revenues of foreign companies in the US or whatever it might be. Remember Section 899 last year, something else that may come up. So it's just keeping on top of it, making sure we're building the right relationships, and then that permeates throughout the business. It sounds simple, it's impossible. How are we solving that? Day to day.
Sounds sound for the business, though.
Yeah.
Do you see a continued divergence between the US and Europe writ large, including the UK, or do you see a balancing out?
I think it's overplayed.
Where's your crystal ball?
Yeah, it's overplayed a lot, but we shouldn't underestimate some of those risks. Just look at the critical minerals price floor, those discussions with the G7, as in EU, US, trying to at least set a price floor with tariffs to at least combat the dominance of the Chinese refined rare earths and supply of critical minerals. That's in train, but it is weakening because of potential threats from the US on tariffs and export controls and foreign direct product rules on European businesses, ASML #1. So yeah, it is overplayed slightly, but we shouldn't underestimate that. Is the US-China diversion or changes in those regulatory regimes? That's the big issue, because BRICS, Shanghai Cooperation Organization versus the West, if that's still a thing, that becomes more problematic.
And Esperanza, with your global hat on, when you look across that landscape, do you see something similar or different views?
Yeah, I think something similar. It depends also what part of the portfolio do you look at. particularly for Australia, the US relationship, China is significant, particularly because it has implications in trade flows and critical resilience also in capital markets. So very similar to Andrew, I would say. But difficult to have that crystal ball. And to your comments earlier on, I think the focus as well should be not only on having the conversation about what will come, but so what and how will affect us, what will break first and what will compound more fastest.
Yeah, I mean, to be fair, we should look at Brussels more than anywhere else, not Beijing or Washington. You know, where are the regulations changing? Is there ever going to be a capital markets union or banking union or wherever that goes? I mean, the answer is probably not yet, but we should be watching that much more closely. What happens in Europe, or the European Union, I should say, will really impact what happens in Westminster, whether it's this government or the next. It doesn't necessarily matter. So really looking at where the EU goes, really understanding how Brussels works. I don't think many people understand how the Commission or Council or Parliament actually function and even agreeing their budget. It's a 7-year budget. They want 2 trillion and it takes 2 years to negotiate. You know, we should be at least influential in that as a global bank.
Excellent. Well, we didn't quite get through the first panel then without getting to the topic of the EU and UK relations, but you know, you can always
try. That was one
try.
of my positive points.
As you think about everyone here as a senior leader in their organization, what is your advice for senior leaders trying to navigate increasingly complex geopolitical landscapes, trying to communicate that to an increasingly diverse group of stakeholders, both within their organizations and outside? What's the one thing that you would like to kind of tell everyone in this room in terms of how they should be thinking about navigating their own organizations?
I just thinking more about it. You know, it's not geopolitics. It's not, you know, just economics. It is just geostrategic issues. What is the environment we are operating in? What are the risks and opportunities? What are the constraints that we're facing? And we have a long-term strategy. This is where we think the world is going. We're not stubborn about it. We will change that. But at least this is our view. This is the regional perspective based on that. We have the right risk management forums or structures in place to navigate that. But it is about consistency of an understanding about what it actually means. When the Politburo produces something, what does that actually look like? What does it mean? And you know, go back to primary sources in a way. You know, let's find out what they're actually saying rather than relying on you know, others to interpret that for us.
And are you seeing and are you pushing for more of a kind of real-time crisis simulation modeling, more discussion internally? Is that something that you...
Yeah, we have our stress tests.
Yeah.
Absolutely. They're mandated by the regulator and they're great. But it's actually the most likely scenarios that are most valuable. You know, I set the scenarios for the bank, for global affairs in a way. So China, where do we think we're going? This is the scenario. Let's test the business, not just risk or legal or compliance. It is the business, credit risk, market risk, you know. And so we all get our ducks in a row.
And Esperanza, from a risk perspective, especially given the fluid nature of the landscape and how things are shifting in the second and third order impacts, I mean, how do you suggest that leaders in their industries and leaders in their organizations interact with the risk function? What type of dialogue do you want to be having and what type of dialogue should they expect to be having with their organizations?
Yeah, I totally agree with what Andrew was saying, and I would add to elevate the conversation to the management, to the executive committee and to the board conversation. Because I think is not only about performing the stress testing just because we need to perform the stress testing. I think and I would actually put less focus on trying to guess what is the most likely scenario, is running the exercise, using that exercise to identify the vulnerabilities within the firm, what will break first, what contagious effects will have with the organization, because that ultimately will help us as well to identify what is the scenario that would hurt us the most, more than what is the likeliest scenario. I think the conversations in which I always say it's very unfortunate that we are called risk management, because we don't manage the risk, right? The risk is managed for the front line, the people, in our case, who is doing the investment or working with the operating companies. So I think that conversation should be brought at the board and at the management level, but in the trying to identify what is the so what, how it affects us, how is it going to change our risk appetite if that scenario were to manifest, and how can, as an organization, make ourselves more prepared if any likely scenario were to occur.
I think particularly important in environments like we are operating in now, our ability to share those stories and to share that analysis, both with the regulators in the appropriate way, but also through forums like this and in these types of communities, to make sure that we are collectively building that resilience in the financial sector, in the communities in which we operate. And I think now more than ever, I think these types of stories and these types of sharing are incredibly important. So I'm going to finish the panel as I always do, and this isn't just to rise to Sir Ken's challenge to be a bit more opportunistic, but one sentence as we go in to the second half of 2026, what are you most hopeful for the future that we are looking at?
I half joked. Christmas is my obvious answer. But
said you're not allowed to use Christmas.
The summer holidays.
Do you know what? As long as avgas doesn't run out by September, no, the reality is, I think stability in the US-China relationship is what I'm most relatively positive about for the second half. Just, a board of trade regulating that relationship will be at least won't be negative. It'll be relatively stabilizing for the next 18 months.
Esperanza.
I think I would refer to Andrew's comment about opportunity. I think my sentence will be that risk brings optionality, and how can we think about monetizing or materializing, or what are the decisions that we are going to make in order to monetize, if you like, or to benefit from that optionality. Because I think definitely, or at least in the area, so the forum that I'm involved in, changing the way we look at geopolitical risk as an opportunity, as making us stronger and more resilient. It was longer than a sentence, sorry, Lisa.
Excellent. Well, and to break my moderator role, I think my own personal view would be that increased communication brings higher levels of collaboration, and that we see a more cohesive second half to the year. Everyone, please thank me in joining Andrew and Esperanza for our first panel of the day.